Following are two income statements for VIX Company for the year ended December 31st. The left column is prepared before any adjusting entries are recorded, and the right column includes the effects of adjusting entries. The company records cash receipts and payments related to unearned and prepaid items in balance sheet accounts. Analyze the statements and prepare the 8 adjusting entries that likely were recorded. And they tell us, note that 30% of the $5,400 adjustment for fees earned has been earned but not billed, and the other 70% has been earned by performing services that were paid for in advance. Our first adjusting entry to record reflects the 30% of the $5,400 change in fees earned that was earned but not billed. So what you see on the screen here is that entry where we debit accounts receivable for $1,620 and credit fees earned. And what this entry does is it records the 30% of the $5,400 change in fees earned from unadjusted to adjusted that represents fees earned that were earned but weren't yet billed. And you see the calculation of how we derive the $1,620 appearing in the bubble. The second entry we need to make involves unearned fees and fees earned as well. In this case, we've been told that 70% of the $5,400 adjustment for fees earned related to fees that were earned but not yet earned by performing services that were paid for in advance. Let me say that correctly. And on the screen you see the calculation of the $3,780 adjustment. In this case, we debit unearned fees, reducing the amount that were paid in advance since now they've been earned, and recording the fees earned for the period since they were earned in this period. As we look down the two income statements, both the unadjusted and the adjusted column, we see the next line item is depreciation expense computers. And the logical adjustment that explains this would be the recording of depreciation expense for the period. So we've got a debit to depreciation expense computers and a credit to accumulated depreciation computers. The fourth entry is just like the third. It's another depreciation expense entry, only this time instead of relating to computers, it relates to office furniture. So we debit depreciation expense office furniture for $1,575, and we credit accumulated depreciation office furniture in the same amount, and this adjusting entry is to record depreciation expense related to office furniture during the period. The fifth entry relates to salaries expense, and we're just moving right on down the unadjusted and adjusted income statement to figure out what the next entry was. And we see we had an increase in salaries expense of $2,205. And what that is most likely the result of is salaries earned that won't be paid until the next accounting period. So we debit salaries expense and we credit salaries payable. The sixth adjusting entry comes from the change we see in insurance expense. If we started with 0 and ended with $1,170 of insurance expense, and they tell us early on that prepaid items in balance sheet accounts get recorded to the balance sheet accounts, then it's most likely that what we're seeing is the entry to record expired insurance for the period. So we debit insurance expense of $1,170 and credit prepaid insurance. Moving down the next line on the income statement, we see that rent expense increased by $900 from $4,000 to $4,900. The likely adjustment that this reflects is rent that was expended but is still due. So to record that expense that we owe that hasn't been paid, we would debit rent expense for $900 and credit rent payable. The next line item down on the income statement that has a difference between the unadjusted and adjusted column is office supplies expense. and we see that $432 was recorded. So the most likely adjustment here is that the office supplies that were recorded on the balance sheet were used up. At least $432 of them were used up. And to record the adjustment or the expiration of the office supplies, we debit office supplies expense for $432 and credit office supplies. The next line item down is advertising expense, and we see there was a $400 increase from $2,900 to $3,300. The most likely reason for that change would be an adjusting entry to record advertising expense incurred that has not yet been paid. So we record accrued advertising by debiting advertising expense of $400 and crediting advertising payable in the same amount. And the last item on the income statement we see is utilities expense, which increased by $63. The most likely reason for that is that we're recording accrued utilities, which means we're recording utilities that we used during the period. In this case, I believe the period is a year, and versus, let me say that correctly, we're recording utilities that were used in the generating of revenues because we're attempting to match expenses to revenues, but they're accrued because we have not paid for them yet. So we debit utilities expense for $63 and credit utilities payable in the same dollar amount.